Welcome to today's webinar on Think Real Estate, Think Retirement. This is kind of an overview and educational course on how to use real estate inside an IRA as an investment. So we'll talk about the reasons, the benefits, and what the rules and regulations are in order for you to do that. My name is Jason DeBono. I'm the Vice President here at the Trust Company. I've been here since 2003, and so over the last 15 years or so, I've gotten to see a wide variety of things in all different markets. And so while we kind of enter this period of somewhat uncertainty, if you will, which we'll touch a little bit on, it kind of takes us back to that 08, 07, kind of wondering what the world will look like. Obviously, we've got a pandemic tossed in the middle of it now that I think it, gives us the inability to really look back completely, but we can certainly look back and see how things fared in the past, and maybe history will continue to repeat itself. As we go through today, obviously I've got the screen behind me. I can answer any questions that you guys have. If you do have them, please use the chat function. Just simply click in that. We've got too many people to unmute, so if you'll just type it into the chat section, I will pause every so often and I'll get those read aloud for the entire group. So without further ado, let me get the clicker here, and we'll go ahead and get started. Awesome. So the first thing that we start every presentation with, for those that maybe haven't been to one of our webinars before, is we are not attorneys, we're not CPAs, we're not financial advisors, and we don't pretend to be. We are educational by nature. We want to share information, but we also understand that every situation is unique, and money is personal to you, and therefore you should be relying on your own advice, CPA, tax professional, legal professional, financial professional, as it relates to any sort of specific or deliberate advice. We'll talk a little bit about what we do as a company and where we fit in, but our primary role is to be a passive custodian, meaning we're here to hold the assets on your behalf, but it is a self-directed account. So all the investment decisions are all made by you as the account holder. So where do we fit in, and what does that really mean? So we'll kind of just highlight on some of these bullets here as we go down. The big thing is we're a custodian of choice. So we give you the ability to choose your investment. So you can go set up your IRA at Schwab or Fidelity at TD, and while they give you choice as it relates to the entire stock market, they don't give you a whole lot of choice beyond that. So people come to Newview when they want to buy an investment that can't be held at a TD Ameritrade or a Fidelity or a Schwab. We're here to let clients buy investments they want to buy. And the beauty, and especially as we enter in these periods of economic uncertainty, we start to wonder what other options are out there. And so for many, the stock market may have served you well for the last 3 or 4 years. But we're getting to a point now where, is it really serving you well? And do you have any level of control? We'll talk a little bit about that here in just a second. We've been in business for 17 years. We've got nearly 50 employees here, about $1.5 billion of custody. So that means about $1.5 billion are held by Newview clients, right? And about 99% of those assets are all non-stock-based investments, right? We do have a small contingent of clients that add a couple stocks to their account or stocks they bought when they were private that have since gone public. But ultimately, the vast majority of what we hold is all non-publicly traded investments. So I mentioned earlier this idea that we're really holding investments that we have no control over, right? And obviously this cartoon here kind of illustrates that, right? We don't have control over the outcome. Now, I don't know everybody's investment philosophy and strategy on here, and there's lots of different schools of thought. And at the end of the day, they're probably all right to some regard. But we have to look at this from a standpoint of control. And I'm a big believer in, it doesn't matter what you invest into, but I only like to buy assets where if it went down, I can determine why so it doesn't happen to me again. If it went up, I can determine why so I can do more of it. And I feel like when I buy stocks and bonds, I never quite know, right? I get to be a Monday morning quarterback. I get to kind of report the financial or read the financial news a day in arrears, right? But I don't actually get that information up front. So I know the stock market went down because of the pandemic after the stock market went down because of the pandemic. And so as an investor, that can be a very difficult market to find yourself in, right? So to tell you how bad I am at stock investing, I sold Apple, Netflix, and Amazon in the middle of March. Now, for those that don't follow the market kind of bottomed out and made this unbelievable V-shaped, almost full recovery. I haven't seen where it is today. It was flat earlier this morning. Almost V-shaped recovery, and here I am selling right down here. Now, on one hand, you would say, my goodness, that makes you a terrible investor, and you are right. From a stock perspective, I am a terrible investor because I had no way to know if it was going to go down or go back up. The good news is I sold my positions at a profit, meaning I've held them long enough, even after that drop, right? I still made money. The bad news is if I'd have held it, I'd have made another 30%. Now, most people make the case that you have to hold them for the long term. Well, at some point, I do have to sell. So I don't know if I'm selling in a peak or in a valley, and the best decision I made was to sell those securities. I look at the market just to understand the craziness, but I don't have a dog in the fight, right? I've put that money into a position where now I can go out and start to find opportunities. So we're going to talk about that today and the power of being ready, right, to buy. And regardless of where this economy goes, I think everybody understands there will be fallout. How much, how deep, how long, nobody quite knows. But we can't have 20+ million people on unemployment and not have some economic downturn of some kind. And a temporary drop in stocks is not necessarily representative of actually the economy. There's that lag, right? So the leading indicator that we've got a problem caused the market to drop. The fact that it looks like we may get out of this a little sooner than people anticipated has caused the rise. But it doesn't account in any way for what's transpired from the day it dropped to the day it's kind of risen up to where we are today. So be mindful of that. Again, I'm not telling you stocks are good or bad. I'm telling you I don't necessarily like investing in them as from a standpoint of buying and selling. I do buy some stocks here and there, and I tend to buy them and hold them for the long term. Again, no right answer there. But if you can't control the outcome, in my opinion, then you're setting yourself up for having to time it on the way down or the way up, and that's a pretty tough decision to have to make. So one of the things I want to talk about, and I clicked ahead, so I'm not sure if anyone saw that, but I want to talk about money for a minute. One of the things that over the last 15 years always seems to kind of, cause me to pause and go, I don't think people are really thinking about the right thing. So many people worry about the investment. Investment this, made this, return this, made this, investment that, right? And I want you to just take that idea of investing and just set it off to the side for a minute. Because what I want to talk about is how we get to retirement, right? And retirement is two parts. It has to do with saving, and then it has to do with how well the money does that we save from a return standpoint. But I want to challenge you guys to change your way of thinking that those really being two separate things. And I'm going to illustrate the importance that almost how you save is actually more important than what you invest into. So this example says, what does it really mean to save money, and how does compound interest really work? Well, compound interest, in essence, is tax-free interest. It means that whatever you grow is added and that money grows again. When we look at what we do in our taxable environment, the money grows, we pay a portion of it in tax, then what's left grows, we pay a portion of that in tax, and then what's left grows, and you understand how it works. So I want to illustrate with this dollar. If I were to take $1, and I doubled it every 20 years. Now, obviously, that's a significant investment feat, right? But just go with me for an example here. If I take that dollar and I double it every single year for 20 years. Now, we can start, right, at $1 becomes $2, $4, $8, $16, $32, $64, $128, $256, you get the idea. But when you start getting out to 20, the number gets a lot bigger. But before we do that without taking any taxes out, I want to start by doing it from a tax standpoint. So if you take $1 and you double it, you have $2, right? $1 profit, $1 of basis. You pay tax on the dollar that you earn at a 25% tax rate. So 25 cents is paid and 75 cents is retained. I now have $1.75. I double that, that becomes $3.50. Of the $3.50, $1.75 was earnings, so I paid 25% on that. And you get the idea. I want to ask you, now I did flip it up there, so for those who were paying adamant attention, you've already seen it, but after 20 doubling periods, you will have $72,570. Now, obviously, that's an incredible sum of money considering we started with $1, right? But I want you to understand that that number of $72,000 is lower than it will be if we didn't pay the tax. But I want to illustrate how much impact that tax has on our growth. So I'm going to use the same scenario, 20 doubling periods, but this time we're going to take the 25% tax rate out. So $1 really does become 2, which becomes 4, which becomes 6, right? And as you can see here, $2, $4, $6, $12, or $8, $16, you can start to see the gap gets bigger. So now I'll ask you, just, kind of in a virtual world, how much money do you think you have if you didn't have to pay tax on that money you're earning? That number is just over $1 million. Now, you can go down and do the math, I assure you. It's been checked and double-checked and triple-checked. Right? So now let me ask you this. What do you think is more important? Making investments in a taxable vehicle or making investments in a tax-advantaged vehicle? So let's take note of a couple key things on this slide because its simplicity drives home lots of points. And I'm going to start with this. Number one, the same investor, right, $1 of savings, made the same investments, doubled every year for 20 years. Yet one investor gets $72,000 to live off of, and the other investor gets $1,048,000 to live off of. Now, I don't have to ask, right, but it sounds good to rhetorically ask, who do you want to be? So when we talk about alternative investments like real estate and other things in an IRA, we start talking really less about what you buy and more about the power of shifting money from this bucket to this bucket. So when you think about your investments, you may not realize how big of a part taxes are playing in that, or you may not realize how much more wealth you can build if there was a tax-advantaged or tax-free way to do it. And the IRS gives us a perfectly legal, permissible one in the form of IRAs. Second key point here is saving. What do you think you'd have if you saved $2 instead of $1 over 20 years? Right? So you'd get to add a whole nother line down here. And you'd add a whole nother line down here too. So when you think about that from a standpoint of saving in the right vehicle, but just saving a tad bit more, what kind of profound impact it can have on your earnings. So before we focus too much on the investments, which we're going to cover in good detail today, I want to remind everybody that the most often looked power of a self-directed tool is not your ability to buy real estate. It's your ability to buy investments tax-free, right? But even if we use the pre-tax IRA, right? Pre-tax means I got to pay tax when I withdraw it. And even if we were in the 50% tax bracket when we retired, and even if we took this $1,048,000 as a lump sum and paid all 50% at once, we would still end up with $524,000 instead of $72,000. And obviously that's as egregious of a scenario as you could probably imagine. Not to say it couldn't happen, right? But a 50% tax rate withdrawing it all at the same time still produces you 4 times as much money, right? Almost 7 times as much money as putting it into a pre-tax account. So it's very important that you understand how IRAs work. They're fantastic tools. I'm going to pause here, and I got a couple of questions or comments, it looks like. Question in here about is it being recorded, and the answer is yes. And as far as the slides, we don't share the individual PowerPoint slides, but the presentation is recorded, which does include the slides running through. Let's see. Will you dig into some of the tax reporting issues involved and most salient that impact everybody and the gotchas and correct assumption? I will touch a little bit on the rules. It says anonymous, so if I don't address that already, please let me know and I will get to that. And then let's see, recourse loans that may be able to the IRA owners. So we'll talk a little bit about non-recourse loans. I'll make sure to cover that here in just a bit. So keep the questions coming. I appreciate it. It certainly helps keep us on track, and it helps understand what it is that you guys want to make sure we cover, and we're going to get to some of that today. So moral of this slide, summed up in a couple key points. IRAs are so powerful because the same investor with the same amount of money and making the same investment can end up with literally $1 million more by simply making those investments through a tax advantage account like an IRA versus their personal money, right? That's the moral of the story, all summed up here. So what does that mean for you? Put back on here. Well, first, before you make an investment decision with a self-directed account, you got to decide what type of accounts or accounts would you like. Now, first things first, this is not a one-size-fits-all, nor is it a one-and-done. To give you perspective, I self-direct a 401k here at UView. I self-direct an IRA. I self-direct a health savings account. And I self-direct an educational savings account for our son. So all four of those, and I'll talk about them here, I have all four, and I self-direct them all. So if you're looking at this list trying to pick one that makes sense, I promise there's probably more than one on this list that makes sense. And your job is to understand how to get as much money into IRAs as possible, because going back to this last slide, whatever, we want to be over here. Right? We want to be the guy or girl that has the money in the most tax-efficient manner, because that will always trump investment if you put money in and take advantage of compound growth, which is exactly what IRAs do. So what are the plan types? Well, traditional IRA is pre-tax. It means you pay the tax when you withdraw. So you get a tax deduction today. That money grows tax-free. And then you pay the tax as you withdraw it. So if you have a $10 million IRA, you don't pay tax on $10 million at once. You pay tax on the amount you withdrew in that particular year. So if I took $50,000 out of my IRA in 2020, I pay tax on $50,000 based on my income in 2020. If I took $100,000 out in 2021, I pay tax on $100,000 based on my tax rate and income of 2021. So you can stagger that, right? A lot of people love the traditional IRA. A lot of accountants do, because it helps them lower your taxes, which is what so many people think they want. But in reality, it may not be exactly what's best for you, right? Because one of the drawbacks to traditional IRAs is why you get a discount today, you're just kicking the tax can down the road and you're paying on the crop. So if you're a good farmer and you build this super big IRA by self-directing it and great strategies and all of that, you may end up with a lot more actual tax burden when it's all said and done. The benefit is you don't have to pay it till later, right? The contrary to that is the Roth. The Roth says, I don't want to wait to pay my taxes later. If I'm retired and I got $1 million IRA to live off of, I want to know I got $1 million, right? If I go to the beach and I order a Mai Tai for $8, I just want to be able to take $8 out of my retirement account to pay for it. The Roth allows me to do that. If I chose the traditional, I may have to take $10 or $11 out of my IRA, pay the tax, and then use the $8 to buy the Mai Tai. A Roth IRA doesn't have any higher contribution limit. It's the same as the traditional, but it is after-tax money. That means however much you contribute this year is how much tax, I shouldn't say how much, is the amount you will be assessed tax on this year. So you put $7,000 if you're over 50 into your Roth IRA for 2020, you will have $7,000 of taxable income that you will have to pay the tax bill on. Right? But it may not be that bad because the tax on $7,000 may be small enough to justify getting it out of the way so that when you get to retirement age, you can focus on retirement. A SEP IRA is for those that are self-employed. It is a pre-tax account, so it does mean that you owe the tax at the end. There's a tax deduction. If you notice here, you get to put in up to $57,000. That's a significantly higher contribution limit, and it's up to 25% of your self-employed income. Typically, people that have this plan are self-employed with no employees. Awesome plan. Simple IRA is for small businesses, less than 100 employees. It works just like a 401k, but it's an IRA. So in the 401k world, you get a payroll deduction, and then your employer makes a match. In the simple world, it works the same way. The employee, you get payroll deduction, so you're making the contribution, but the employer takes it out of your paycheck, and then the employer can add a match to that. Great plan if you qualify. It's a pretty relatively uncommon plan, just because most small businesses, once they have 6 or 8 or 10 and 12 employees, instead of the simple, they're biting the bullet and just going right with the 401k. It's a little bit more, it has a lot more function to it. HSAs, I mentioned this plan. So for those of you that are out there that have high deductible health insurance, that means that you are 100% responsible for your out-of-pocket expenses up to at least a $1,200 deductible, or maybe $1,250. You qualify for an HSA. So what does that mean? Well, first of all, I'm not on the insurance side, nor am I an insurance agent. So don't quote me or expect me to get this 100% spot on. Talk to a qualified insurance agent about it. But what I do know is this. When you buy insurance, you have really 2 different ways to buy it. You can either pay a little bit more per month and pay a little bit less when you go to the doctor, or you can pay less per month as a general rule, and then pay more when you go to the doctor. So I view it as self-insurance, right? Thankfully, I'm a relatively healthy guy, haven't had any major complications, or, and I'm also kind of the guy that my wife would have to literally drag me to a doctor's office for me to go. I'm not proud of that, or am I saying that's okay, but I think you understand kind of the persona, right? I don't go to the doctor unless I really, really have to. So my view is, why would I pay for the right to go to the doctor and prepay it when I don't actually go? I'll illustrate this in something that happened to me about 7 or 8 years ago. My dental insurance, right, has some sort of it has some limits on it. So I remember being at the dentist towards the end of the year, and I was getting a cleaning, and the dentist said, "Hey, do you want to schedule anything before the end of the year?" And I thought, well, that's a pretty peculiar question, right? And I thought, you tell me, Doc, is there something going on that I need to know about? And he said, well, you have $4,000 of unused benefits in your insurance plan. And I thought to myself, well, unless I've got something wrong, I don't need to schedule it, right? But what he was helping me understand is that I bought that. Every month I made a payment, I bought the right to spend $4,000. And when I didn't, the insurance company won the game. So I've been on high deductible health insurance, I don't know, probably 8 years now, maybe even longer, because it gives me 2 things. Number one, it's the cheapest way for me to insure myself, meaning it's the lowest monthly payment. The second thing is I'm incentivized via an HSA to where I can contribute money up to $3,050, $3,500 as an individual, $7,000 as a family, where I can contribute money that's my money, but it goes to pay my medical expenses. So if I put in $3,000 this year and I don't spend $3,000 at the doctor, I now have $3,000 that rolls over to next year. And as you can see, if I do that just for a couple of years, I could have ample money to pay any medical expenses that I may come across in the future. I have successfully used this HSA tool. I have saved a lot of money over the years in my HSA. I get a tax deduction to put the money in, which is fantastic. And more importantly, when I take it out to pay medical expenses, it's 100% tax-free. It's the only plan that gives me tax deductible all the way in, tax-free on the way out. The reason I share that is because I think it's one of the best plans for those that qualify, and you need to talk to an insurance provider to see if high deductible is best for you. My brother asked me about this about 5 years ago, and it was very simple. He saved about $120 a month to move off of a copay plan to high deductible. So it's about $14,000 a year, or sorry, $1,400 a year. His deductible was $3,000. His employer gave him another $500. So he saved $1,400, basically taking just what he saved in payments, so that he didn't add any more money. He just added what he would have already paid to the insurance. He took the $500 from the employer, and in year one, he had $1,900 of his $3,500 deductible saved. So once you go through 1 year without hitting your deductible, now that $1,900 rolls over, and if he does it again, he's got $3,800, right? And if he doesn't have any expensive needs at the doctor, that rolls over. So you get the idea. I'll get off my soapbox, but I encourage everybody on this call to take a look and see if you can get an HSA, because it is an awesome, awesome tool. If the high deductible insurance makes sense, right? That's the part I can't assess for any one individual on this call. Educational savings account, for those with kids, great way to save. It is not a 529. Some of you may be familiar with that. It is not a prepaid plan. This is a savings account that's tied to a minor, right, that is contributed to by any party, which is really cool. So if grandparents or aunts and uncles want to give your kids money, right, instead of putting it into a bank account or giving them a little bit of cash, I take all the money from birthdays and Christmas and everything that our son gets, and we take it and put it into a DFS. And then at the end of the year, whatever's left, we add in to try to get us, if we can afford to get to the $2,000 a month. And then when he reaches, either college or some form of vocational school, because educational savings account is not college-based, he could even use it for private high school if he was inclined, or we were inclined. It's a fantastic tool. I'm not saying it's better than the 529 or than college prepay. For us, it was better. Take a look at it for you. For those that are self-employed, I would strongly encourage you to go onto our website, click on the blog section, and scroll down so you see the solo 401k presentation. If you're self-employed without employees, you should have this plan. There is no better way to save for retirement with the highest ability to contribute and the most flexibility within the plan. This is the best plan on this entire screen, but you only qualify if you're self-employed with no employees. So don't worry if you don't qualify, that's okay. But if you do qualify, don't let that opportunity pass you up. Go watch that webinar. It's about 45 minutes to an hour, but I assure you it's worth every second of it. I love that plan for those that qualify because it gives you lots of flexibility. But again, only for those self-employed and only for those without common law employees. Why did I go through all of this with you? Again, you guys are saying, come on, Jason, I'm here to learn about buying investments. It's because it's my job to ensure that you don't overstep one of the biggest part of the decision-making process, and that is, where do I put the money first, right? And if you've already got it, that's okay, but you may want to add more money this year, next year, and the following. This is your menu of tax advantage choices. This menu, right, allows you to be this person and not this person. If you ignore these plans, right, by default, you're leaving your money in a taxable state, and every time it earns money, your business partner, also known as the IRS, is going to take it right off the top. Now, there's some strategies to eliminate that, but the only way to truly eliminate taxes from your annual transactional activities is to do them in IRS. Let me pause there for questions, if we've gotten any. Let's see. Question says, can I move money from my HSA from my employer to NewView? Great question. The answer is yes, as a general rule. Typically, the way that works, your employer can't force you to keep your HSA somewhere like they do in a 401k. So if you have a 401k with your employer, typically you cannot move that. But because there's no vesting schedule in an HSA, it's your money. You're eligible to do with it what you want. It's not a group plan. So you can move it likely, and I can't speak to how your employer handles it. What we typically see is you won't move the whole IRA. You'll just transfer the cash out of it to an HSA with us, and you'll leave the HSA there. A lot of times employers will only defer your HSA contributions to one place. So you may not be able to keep your ongoing contributions or their contributions, if they're making them, going to us directly, but you can indirectly have it go to where it is today. And as frequently as you want, we can move the cash out of that plan and over into your HSA at NewView. And one of our new account specialists can walk you through that. It's a pretty straightforward process. All right. So now that we know we need to have the right plan and we understand that, wow, what a difference a plan can make from a tax perspective and overall wealth building strategy, let's talk about what you can't do. So kind of jarring, right? Here's the plan, and then here's what you can't do. The reason that I like to go through it in this manner is because I want to make sure everyone understands before your mind starts racing to the investments, I want to tell you two things. Number one, pick the right vehicle, which is what we talked about. Number two, there are a couple limitations inside IRAs. Because of that tax advantage growth, the IRS puts a little bit of a fence around these accounts and says, we need to make sure that there's some basic rules followed. Otherwise, people will use this as a tax haven, and they'll just do stuff that's really beyond the IRA, all right? And they'll do stuff that violates the tax incentive that we're offering. So remember this. The IRS, really Congress approves all this, but has provided you a tax incentive to save for retirement. A tax incentive to save for retirement. So they define a few sets of rules on what you cannot do. Number one, you cannot purchase life insurance. Well, that makes sense. They're giving you a tax incentive to save for retirement. They don't want you taking that vehicle and buying life insurance, which is really saving for your debt, right? Not to say life insurance isn't a great tool. They're just saying you can't use your IRA, which is designed to get you to retirement, and invest all the money, or any of it for that matter, into anything that really is that goes past retirement and into your debt. So no life insurance. And then no collectibles. The IRS doesn't allow collectibles because of a valuation standpoint. There is no real way to understand what a Picasso painting is worth. There's no real way to understand what a collectible rug or gem is actually worth, because it's based on numismatic value, not intrinsic value. So when we look at this, the reason they prohibit it is, how could they possibly look back? If the IRS audited you, and remember they audit in arrears, it's not in real time. If they audited you for something that you did in 2018, and let's assume that they thought you did something fraudulent in your IRA that involved artwork. Now, obviously it's prohibited, but let's assume it wasn't. How would they even be able to go back and get an idea from a transaction standpoint if it was within the boundaries? Yet with real estate, I could go back and look at a transaction you did 2 years ago. I could look at all the comps in the area, and I can get a pretty decent idea. Did you sell $1 million home for $5,000, or did you sell $1 million home for $985,000? Right? One is easy to kind of understand the story, and the other one, right, tells me, hey, something may be up here. With artwork and other collectibles, they just can't do that. So easy, no artwork, no collectibles, right? No life insurance, prohibited. Item number 2 says your IRA has to act solely in its own best interest. And to ensure that it's acting in its best interest, we cannot let you, the IRA decision maker, put that money in or out of the hands of certain people. Because the IRS says it's probably not prudent if I use my own IRA to loan it to myself. Chances are I'm not acting in the best interest of my retirement account. I'm probably acting in my best interest. So to prevent that as best as possible, the IRS defines a group of people that the IRA cannot transact with. Has nothing to do with what you buy. It has to do with who you buy it from or through. So, for example, my IRA can buy a house, but my IRA cannot buy a house if I'm the one that owns it today, because I would have to personally sell it to my IRA, creating a transaction. And the IRS knows it's highly likely that I would sell it at either a discount, right, which would tuck my profits into my IRA, tax-free, or I'd sell it at a premium, potentially, which would allow me to get money out of my IRA. In either case, the IRS says it's not allowed. Your IRA can never do business with you, your parents and grandparents, your children and grandchildren, and the spouses and businesses owned by any of those parties. So if my IRA cannot loan money to my dad, my IRA could not loan money to my dad's business, right? It would be equally as prohibited. So if you're thinking about this as a tool to get money out of your account, you're thinking about this as a tool to loan it to you or to invest in deals that you benefit from personally, the IRS says that's not it. The IRS allows you to use your IRA to buy just about whatever you want, so long as the parties that you buy and sell it from are unrelated. So for most of our clients, non-issue, right? They're simply buying because just like they buy stocks. There's no real personal benefit. They buy it because they want them to be good investments. If you're buying them because you want them to be good investments and you're not trading money with you or your family members in most cases, then you'll have no issues at all. For the small group of you that may be thinking about some strategies that may involve some of these parties, the answer may not be no, but you definitely need to at least talk to our team first, and then probably talk to some legal counsel to make sure that you're not going to get yourself in trouble. I know one of the questions that came up earlier was, can you kind of help people understand the pitfalls? In my opinion, this is the biggest pitfall. Because what happens is people start getting really creative in these deals, and they start involving these types of people for all the wrong reasons, and the IRS doesn't allow it. And so you don't want to get to the closing table where you're submitting paperwork and you're just ready to sign it, and we look at it and say, Bill Smith is lending money to Mike Smith, because our team will ask, who is that? And when you tell us it's dad or something along those lines, we may have to tell you it's prohibited, right? It's not our job to vet your investments. It's not our job to be the police and the judge and jury. But we also understand that if we see something, we're going to act, right? So that can trip people up. Know the rules. And if you're coming here to try to skirt them, self-direction may not be for you. If you're coming here because you want to use your IRA to make passive investments with mostly unrelated parties, then self-direction is a very, very powerful tool. So what does it mean? Well, it means that if you can't do, and I don't know how many of you on the call have kids, but I liken this to the toddler principle, right? Think about it. How do we chase toddlers around the house? Don't do that. Get down from there, right? Don't eat that. Don't touch that. Well, we do that because we believe that if we tell them all the stuff that's no, which is this amount, they'll understand all the stuff that's yes, which is this amount. Well, Congress and the IRS wrote these rules the same way, right? They're basically saying we're not going to tell taxpayers everything they can do in their IRA. That would be miles and miles of code. But if we tell them all the things they can't do, right, then the world becomes their oyster. So what's awesome about this, even though it does feel a little toddler-like, is that we know the very few things based on this slide that we can't do, and it's small. Everything else that's not on this slide is permissible. So what does that mean? Real estate, private stock, partnerships, tax liens, tax deeds, LLCs, precious metals, mortgages, notes, you name it, we've got clients doing it. And what's cool is we get to kind of see this wheel, right, get a little bit lighter and a little bit darker and a little bit more expensive based on where we are in the marketplace. So I can just tell you that this precious metals bucket has gotten a lot bigger in the last couple months as many people seek a safe haven in metals as it relates to economic uncertainty. And the beauty is, whether I agree or disagree, it doesn't matter. My job's not to agree or disagree. It's simply to provide the custody for them to go do it. So we give our clients the ability to say, you know what? I'm looking at this market and I'm saying something's got to give. It can't possibly be, it's being propped up. And when it drops, I don't want to be anywhere near it. But what I do want to be near are the asset classes that tend to go up, right? And so a non-correlating asset to the stock market tends to be precious metals. That's an example of how clients use self-direction. Even if they opened their account 10 years ago to do other things, they're pivoting as they see the market changing. So when we talk about buying investments on sale, right, well, what does that mean? So I remember it was right before, and I'm in Florida, depending on where everyone else is, it was right before they shut everything down. Thankfully, right, I went in to get a haircut. And I remember walking in, it was a group of younger guys in the barber shop. And I, obviously engaged in a conversation, how you guys doing, et cetera. And one of them said, oh, we're just trying to figure out what cheap stocks we want to buy. And I thought, why do you say they're cheap? Oh, man, because, the market's dropped. And there's some validity to that, right? However, they're not cheap if you're paying the same price as everyone else. That's called market value, right? What I talked to him about was I help clients buy cheap investments. Cheap meaning less than the person next to him paid. Because if you and I both go buy Microsoft today, we're paying the same price. Now, if I wait and buy it at a different time. But with real estate, it truly is priced as it sells. Now, yes, there's a market value, and yes, there's comps and basic, price per square foot. But I can go and find examples of properties to buy. I will give you one. My wife and I recently bought a vacation rental condo, right? Now, maybe probably not the world's best timing, but we were looking at kind of the Airbnb space, nightly, weekly rental stuff. So we were looking at various condos, and so we found a condo, right? And it turns out it was a distressed seller. Now, for those of you that kind of look at buying investments, right, we all tend to do the same thing from a real estate standpoint. We look at price per square foot. It doesn't take long to look in an area to know roughly what stuff's selling for. Long story short, we actually bought the property for less than they paid for it in 2017. Now, you're asking yourself, like, wow, well, obviously, prices have gone up from 2017 to 2019. We actually just bought it in 2020. So prices have gone up over 3 years, yet we paid less than they did 3 years ago. And it was because they needed to sell. There was an assessment coming on the property. They didn't have the ability. They were going through a divorce. They couldn't. All those reasons, right, allowed us to buy it on sale, truly on sale. Whereas if somebody would have went and bought the unit next door, which is the exact same model, so theoretically from a price per square foot standpoint, it's the same, they'd have paid 20 or 25% more. That's what self-direction allows you. You cannot get that in the stock market. And all of these investments can be done that way. Tax liens, tax deeds, right? When you say they're on sale, no, it has to do with how much money people are willing to bid the interest rates down, right? The less people buying and the more unique properties you find, or the more you're able to do your research, you can actually buy well below. Right? Non-performing notes. Obviously, we have this in all market cycles, even in a rising economy. But if we believe there's going to be question marks about where the economy is going, which I certainly do, I just don't know what it looks like, non-performing notes start to look extremely attractive. Structured settlements, a big investment vehicle. A lot of people don't realize. But if you go out and you get hit by a car in an accident, you sue them for $100,000, right? Their insurance company, Allstate or whomever it is, isn't going to write you a check likely. They're going to offer you some long-term payout. And you're going to likely accept it because it appears like more money. And then you realize, I don't want $500 a month for the rest of my life. I want $150,000 today. So you may sell that out at a heavy discount, right? Structured settlement. And then private stock and startup companies. The earlier you get in, the better off you may be. And you may be able to, if you have money, you can negotiate with a lot of potentially small companies that seed capital and give yourself better ownership interest as a result. So all of these opportunities are ways to truly use your knowledge and experience to benefit you on an investment side. So we talk about loans, right? Now, obviously, the reason we talk about real estate and loans in the same breath is because, as far as I'm concerned, with the exception of loans that are non-real estate and lending are the same. One is the equity side of it, one is the debt side, but you tend to need both to make the world work. So what's awesome about the lending side, and this is where I tend to do more of my personal investing, is on the lending side, right? But you get to pick all of this. There's this saying that I had a client tell me many years ago, right? And he said, and it's pretty cliche, right? When it comes to private lending, never forget, he who has the gold makes the rules. So when I have people ask me about my lending criteria, I tell them, if they don't like it, I don't have to lend to them. So when I go out and I look for deals, I find the deals that I like. And I get to negotiate all of this, the loan amount, the interest rate, amortization, how long, right, you're going to keep the money for, whether you pay it monthly, quarterly, all of these things, right, are all decided at the time of the loan. And what's beautiful about loans in an IRA is they can be very passive and easy to manage in a self-directed account. Not to say real estate is hard to manage, but there's more moving parts than real estate, right? You got toilets and tenants. We're here. You got to collect a check each month. And if they don't pay, yeah, you may have to go take action. But think about this. You can invest into a stock, right? And if that stock cuts their dividend, which says I'm no longer going to pay, you get zero recourse. Yet if I loan you money and you agree to make a payment and you stop making the payment, I have all the recourse that I got when I bought it. If I chose no recourse, meaning unsecured, that's on me. But if I have recourse in the form of a property or asset, I can move through that property. Okay? So a lot of strategies here. Let me pause for a second. Let's see how we're doing on questions. All right, it says, any problem if the property is overseas or land? Great question. Actually, this next slide here will actually kind of references that. There is no issue at all with either of those. I will touch on this. If you're buying a foreign investment, make sure that you give us a little bit more lead time and talk to our team up front. The other thing is you've got to be prepared to talk to whomever it is that can give you information from the country that you're purchasing from. Some countries require that you have an entity created in that country, right? So you want to buy a piece of real estate in Costa Rica, you have to have a Costa Rican corporation. You'll need a Costa Rican attorney to establish that for you, right? We actually just this morning, we have a client that's investing into a private stock in the UK, right? So we don't know the rules that they have. We can tell them what our process is, but they have to understand how that works. And they have to accept titling in the IRA. If they don't, then we've got to work through an LLC or some sort of entity to get there. So all of these deals can be done. Raw land is simple. Domestic property is simple. If you're buying foreign property, it's not hard, but there's some things that you want to make sure you're crossing a few T's and dotting a few I's before you fully commit, because our ability to buy is there. But whether or not they can accommodate, like for example, if they require somebody to be physically on the ground in the country signing for the purchase, right, we can do it, but it's not going to be one of us going. We're going to have to find a third party, a legal person there that can accept signature authority. So there's some things that you're going to want to make sure that you're looking through. So I don't want to scare you off by any means. I just also want you to understand that you got to ask the right questions, and our team can help you through that process. But raw land, rehab, rental property, it really doesn't matter. All types of real estate can be bought in IRA. The other thing that I want to touch on is real estate can be bought 3 different ways. The first way is all cash. So if you're buying a piece of land and it's 20 grand, you pay 20 grand. If you want to buy a house that's 200, your IRA needs to have 200. It's a cash purchase. The second way to buy is what we refer to as partnership. Now, not legal entity partnership, but partnership between multiple buyers. It's referred to, I believe, in the title world as tenant in common, right? That means that more than one of us are going to buy this property as a tenant in common. So when we go and buy this property, let's say that $20,000 property, one of the things that I would do in a scenario like that is I may commit to buy that $20,000 piece of raw land. I'll put $10,000 for my 401k, $5,000 for my HSA, and $5,000 for my son's ESA. That would mean that my son's ESA owns 25%, my HSA owns 25%, and I own 50%. That would mean all income would be split the same way, and all expenses get split the same way. Because we're related, we can do that because we're buying alongside each other. Just like my account can buy shares of Microsoft and my son's account can buy shares of Microsoft. But in order for us to maintain it over the life, I have to be sure to only pay each account's prorated interest of expenses from that respective account and collect money in the same prorated manner. So if my 401k owns half, but I pay 100% of the tax bill, now I violated the rules because I just paid an expense out of my account for my son's ESA. That's prohibited. But if my son bought it in his ESA and my son's account collected all the income and my son's account paid the expenses prorated to its ownership, no issues at all. The third way to buy real estate is through a non-recourse loan. So you can actually use debt inside an IRA. Now, we're not going to cover the full details, but I will address it because it was asked. In an IRA, only non-recourse financing can be used. What does that mean? It means that a traditional loan that has recourse back to the signer of the loan cannot be used. So I cannot go into Bank of America, get a loan for my IRA, and then sign that says somewhere, if my IRA stops paying, you can come after me. A non-recourse loan means there is no recourse back to anything beyond the property. So in an IRA, if I put 30% down on a house and I sign off on a non-recourse loan, a bank will loan my IRA the rest of the money. Now, they're going to want 30 to 40% down, rightfully so, because the property is their only recourse. They want to have some downside protection. The second thing they're going to want to see is that the rental proceeds, right, from that property will cover the mortgage, because non-recourse loans are not individual-based loans like regular loans are. They're asset-based loans. So it basically says, the bank says, I'll write a loan to that property based on the property's ability to repay. So the first thing is I want a down payment to protect me if the property value drops. And secondly, I want to ensure that whatever the mortgage amount is always less than the amount that property can generate in cash flow, right? So it's an asset-based loan. Almost everything in the commercial world is, and that lots of those loans are non-recourse by nature. In the residential world, there are lots of lenders or a good handful that will write these loans to IRAs. But just understand that your down payment requirement is going to be in the 30, 40, 50% range, right? Which isn't scary in an IRA, but it's still something you have to be prepared for. The other thing that I'll share on this is if you take out a non-recourse loan in an IRA, you subject the IRA potentially to tax on the leverage portion of the gain. Now, I'm not going to get into the weeds on this. Again, on the blog section of newbietrust.com, there's a whole presentation on non-recourse loans and UBIT or UDFI tax. But what it says is this. If you took $50,000 and put it down on a house and borrowed 50, right? 50% personal or 50% IRA money, 50% leverage. The IRS says the 50% of the income that you earn off the leverage, that bank's money, the non-IRA stuff, we're going to clip a little tax on it, right? Again, not going to get deep in that today. Just want to give you a little background on that as well. So let's see what we got here. Now would be a good time to ask questions. Got a couple slides left, and we're going to wrap up. So one of the things we talked about individuals' ability to buy and sell investments outside the market. Now, obviously, real estate, and we could, just so you know, we could spend the entire time, just going through random examples. And what we found in the past, that doesn't necessarily help people understand how it works. Where we really try to do the general math education is really to give you an idea of the overall picture of self-directed accounts. And it's really best to talk one-on-one with our team about specific scenarios and investments. But I'll leave you kind of at least summarize with this. So long as you don't buy investments that are inside your close family members, right, it can generally be done in an IRA. Now the how, right, may need some answering, but as a general rule, as long as you steer clear of certain family members and life insurance and collectibles, you can make any kind of investment you want. And so in the 15 years I've been doing this, just when I think I've seen it all, I get another call on a unique investment. So this morning I got pulled in on something. It was the first time I've ever seen a client buy private stock specifically in the UK. We've had clients buy stuff all over the world, but it was the first time I ever had that particular item come up, right? And that's the beauty of self-direction. If you think it's a good investment, it can be made. So what do? Well, we provide the administration and custody. That's our job. Right? We provide all the signature responsibilities for your account. So we're going to have you sign off on everything that you've approved it, but we are actually the signatory on behalf of your retirement plan. We'll do all the IRS filings on your behalf. So 5498 annual filing. If you take money out 1099, those are filings that we do as well. We collect all the income, accept contributions, send out distributions. We pay the expenses on your property. So you can have a property manager if you want that's responsible for the day-to-day, or you can direct us every time there's a payment that needs to be made. And the beauty is you can go right on our website just like you would onto your bank's bill pay site, type in the payee, and get that paid. Right? So what's next? Well, the first thing is get set up with someone on our team, right? Let us walk you and talk you through the process. We like informed and educated clients. So if you have specific transactional questions, direct those to our team and we can walk you through those. Get your account set up. Once it's set up, you're ready to go. We're seeing a lot of people starting to move their accounts into a position where they can seize the opportunity. Whatever it is, they're getting themselves ready. And as we've seen the market kick back up, we've seen a tremendous influx of people liquidating their positions, moving to cash and getting themselves ready to take advantage of opportunities that lie ahead. Once the account's with us, find your investment and then work with our team to get them funded. You can text the word NOW, N-O-W, to 33339, so 33339. And you can schedule a consultation, but also get our free self-directed e-guide. It's a great document, and it kind of puts into words a lot of things that we talked about today. I know some of you, may be more visual than audible, learners, and so that can be a great way for you to get some additional information. I will pause and take any questions if there are any as we wrap things up here. So let me get this open. I don't see any questions coming through. I'll give it just a minute here. If you have a question, now would certainly be the time to get it asked before we close it down. Okay. Well, I want to thank everybody for joining us. Keep an eye on our website and our emails. We've got a tremendous amount of educational content that we put out. The blog section on newviewtrust.com is chock full of events and other things that we've done in the past, some recorded activities, but we've also got a lot of live stuff if you want to be able to ask questions that we would encourage you to come to. Somebody asked about how we charge. The way that we charge our fees, we charge a transactional fee of $95. So if you have us buy a house, sell a house, $95. And then the annual fee is either paid on the balance of your account, so there's a table, you can pull it up right on our website, or you can pay a flat fee of $295 for that asset, right? You will find our fees to be right in line with everyone else. Everyone charges a little bit different, but all the fees tend to work out to be about the same from company to company. And if you're unsure about how a particular fee assessment works, let us know and we can walk you through it. The thing that I'm very proud of, and from our fee standpoint, is we only charge you for the activity you generate, right? So if you do nothing, right, meaning your activity is lower, you'll pay less. If your activity is higher, you'll pay more. We don't believe in charging people more because they have more money with us, right? It's activity-based, and so you're paying us from an activity standpoint. So thank you for that last question. We will wrap up there. I appreciate everybody's time today and look forward to having you guys on future events. Thank you.